What if I told you that more money vanished from gold markets in a single day than the entire GDP of Switzerland? On Friday, February 1st, 2026, gold crashed over 8% in the most violent single-day decline we've seen in over a decade. But here's what nobody is telling you. Just 24 hours earlier, gold had touched an all-time record high of 5,608 per ounce, smashing through every barrier, every resistance level, and making history. This wasn't just another rally. This was gold reaching heights that inflation-adjusted calculations said were impossible. So what just happened? Is this the end of the gold bull market, or is this crash the opportunity of a lifetime? Stay with me for the next 12 minutes because I'm going to show you exactly what's happening behind the scenes. The central bank buying spree that won't stop, the geopolitical powder keg about to explode, and why $89 billion flooded into gold last year alone. Let's dive in. All right, let's break down what just happened in gold markets because this is absolutely unprecedented. On Thursday, January 30th, gold reached 5,608 per ounce. Think about that number for a second. The previous record high from August 2020 was around 2,275. Gold has more than doubled in less than 6 years, but Friday was carnage. Gold tumbled from 5,608 down toward $4,900. That's over $700 per ounce evaporated in hours, an 8% crash. Trading volumes exploded. The COMEX gold futures market was processing over 300,000 contracts per day. That's $150 billion in daily trading volume at these price levels. But here's what you need to understand. Despite this violent correction, gold is still on track for its sixth consecutive monthly gain. January 2026 saw gains exceeding 15%. Let me repeat that, 15% in a single month. That's the strongest monthly performance since the 1980s. So what's driving this insanity? Four major forces are colliding simultaneously. First, a Federal Reserve leadership crisis. President Trump just nominated Kevin Warsh to replace Jerome Powell when his term expires in May. Warsh is a former Fed governor who's called for regime change at the Fed, but he's got uncertain Senate confirmation ahead. Markets hate uncertainty, especially around interest rate policy. Second, central banks went absolutely crazy buying gold in 2025, 863 tons purchased despite record high prices. Poland bought 102 tons. China added gold for the 14th consecutive month. These aren't speculators. These are sovereign nations stockpiling gold like there's no tomorrow. Third, Middle East tensions just hit levels we haven't seen in decades. Iran is threatening to respond like never before. The EU just designated Iran's Revolutionary Guard as a terrorist organization. President Trump deployed additional military forces near Iran. We're talking about potential conflict in the Strait of Hormuz, where 20% of global oil flows every single day. Fourth, record-breaking investor demand. Gold ETFs absorbed $89 billion in 2025, more than doubling assets under management to $559 billion. And that's institutional money, hedge funds, pension funds, and retail investors all piling in. Now, you might be thinking like, okay, but gold just crashed 8%. Isn't the party over? Not even close. Let me show you why. Let's talk about what happened the last time gold went parabolic, because history doesn't repeat, but it sure as hell rhymes. January 1980, gold spiked to $850 per ounce during an era of double-digit inflation, oil crises, and the Soviet invasion of Afghanistan. That peak stood for over 40 years as the number everyone referenced. But here's the kicker. When you adjust that $850 for inflation using today's dollars, it translates to approximately $3,600 to $3,074, depending on which methodology you use. Gold just blew past that level by over $2,000 per ounce. We're not just making new nominal highs. We've shattered the inflation-adjusted record that stood for 45 years. Now, in 1980, gold crashed from $850 down to around $300 over the next several years, and 65% decline that devastated late buyers. So should we expect the same thing now? Here's why this time is different, and I don't say that lightly. 1980. Central banks were net sellers of gold. They were dumping reserves, viewing gold as a barbarous relic from the past. 2026. Central banks are net buyers to the tune of 863 tons annually. That's 82% above the historical average. China, Poland, Turkey, India, Russia, everyone's buying. 1980. The Fed raised interest rates to 20% under Paul Volcker, crushing inflation and making bonds incredibly attractive versus non-yielding gold. 26. Real interest rates are still barely positive in many countries. The Fed is under political pressure to cut rates, not raise them. Completely opposite dynamic. 1980. Gold was primarily held by individual investors and jewelry consumers. limited institutional access. 2026. We've got $559 billion in gold ETFs providing instant liquidity and institutional access. Gold has become a legitimate asset class in professional portfolios. 1980. US dollar was challenged but still dominant without serious alternatives. 2026. We're witnessing active de-dollarization. Countries are deliberately reducing dollar reserves, building alternatives like BRICS payment systems, and stockpiling gold as insurance. During the 1970s bull market that led to the 1980 peak, gold experienced multiple corrections of 20-30% along the way. Each one looked like the end. Each one shook out weak hands, and each one set up the next leg higher for those who held on. The difference? Today's fundamental support is far stronger than it was back then. Don't just take my word for it. Let's hear from some of the smartest minds in global finance, people who move billions of dollars and have decades of experience. Grant Spora, global head of metals and mining at Bloomberg Intelligence, recently said, and I quote, "Gold's eye-wateringly expensive, but the market is happy to pay the price in order to secure that insurance." Think about that phrasing. Eye-wateringly expensive. Even the experts acknowledge gold is priced at extreme levels, but they're saying the market doesn't care because the insurance value is worth it. He goes on. Compared to US equity markets, gold still looks relatively cheap, and prices could vault higher still if stock markets begin to crack under pressure. That's a crucial insight. If you're worried about a stock market correction, and with valuations at historic extremes, you should be. Gold might actually be cheap relative to the risk in equities. Carmen Reinhart, former chief economist at the World Bank Group, puts it even more bluntly. Gold is only reflecting the renewed awareness that inflation can be and still is a problem, but also uncertainty about the world. Gold's role as an inflation hedge was a stamp of its popularity in the 70s and 80s, but you need to look before the 1980s. Gold has always played an important role when there's uncertainty. Gold has always played an important role when there's uncertainty. Look around. Do we have uncertainty? Federal Reserve Chair nomination in question. Check. Middle East on the brink of war? Check. $2 trillion annual U.S. deficits? Check. China-U.S. tensions escalating? Check. Inflation still above target in most countries? Check. JP Morgan, one of the largest banks in the world, is forecasting that central banks will maintain approximately 190 tons in quarterly gold purchases throughout 2026. That's baseline structural demand that provides a floor under prices. They're also projecting sustained investor demand of approximately 250 tons in ETF inflows this year. That's not speculative hope. That's their base case scenario. Morgan Stanley has set price targets of $4,800 per ounce for 2026. Bank of America projects gold averaging $4,538 throughout the year, both well above current levels after the correction. These aren't gold bugs running YouTube channels. These are institutional banks with compliance departments, legal teams, and fiduciary responsibilities. They don't throw out wild numbers. Now let's talk about the supply-demand fundamentals, because this is where it gets really interesting. Global gold mining production adds approximately 3,000 metric tons per year. That's it. That's all the gold that gets pulled out of the ground annually worldwide. And here's the problem. New discoveries are declining. The easy gold has been mined. Companies are digging deeper, going to more remote locations, facing higher costs and environmental regulations. Production growth is basically flat. You can't just decide to mine more gold because the price went up. It takes 10-15 years to develop a new major mine from discovery to production. The supply side is basically fixed in the short to medium term. Now compare that to demand, and this is where the math gets explosive. Central banks. 863 tons purchased in 2025. That's 29% of annual production right there. And this buying is non-discretionary. These aren't traders trying to make a quick profit. These are strategic reserve decisions that don't reverse based on price. But wait, there's more. China officially reports 2,306 tons in reserves, but independent analysts at ANZ estimate China's actual holdings at 5,500 tons. That's more than double the official number. Why would China hide gold purchases? Strategic reasons. They don't want to signal their moves to markets. They don't want to drive prices against themselves while they're accumulating. Jan Nieuwenhuis, an independent analyst who's spent years tracking Chinese gold flows, estimates total Chinese monetary gold reserves at 5,411 tons as of Q3 2025. If he's right, China has been secretly buying on a scale that dwarfs official reports. ETF demand. 89 billion in 2025 translated into roughly 2,400 tons at average prices. That's another 47% of annual mine production. Jewelry and industrial. Still consuming 1,500 to 2,000 tons annually, primarily from India, China, and Middle East markets. Let's add it up. Central banks, doctored 860 tons, ETF investors, 1,400 tons, jewelry, industrial, 1,750 tons. Total demand, 4,010 tons. Annual mine production, chart 3,000 tons. We've got a 1,000 plus ton annual deficit between new supply and total demand. Where's that gold coming from? Recycling helps. People melting down old jewelry, selling coins and bars. But that's a limited source. At some point, the available supply of physical gold gets tight. And when physical supply gets tight while demand stays strong, prices have only one direction to go. Wang Qing, chief macro analyst at Orient Gold and Credit Rating International, notes that China's continued modest gold purchases amid sustained price rises highlight efforts to optimize the composition of international reserves regardless of short-term price considerations. Translation: China doesn't care what the price is. They're buying for strategic reasons. If sovereign nations are buying regardless of price and investors are pouring in $89 billion and supply is fixed, you do the math. All right, let's talk numbers. Where could gold go from here? Let me give you three scenarios: bear case, base case, and bull case. Bear case: the rally is over. In this scenario, Kevin Warsh gets confirmed as Fed chair and immediately pivots hawkish. He raises rates aggressively to fight inflation despite political pressure. Real yields turn significantly positive. The Middle East situation de-escalates. Stock markets hold up. Dollar strengthens. Gold could retest the $4,400-$4,200 range, basically giving back most of January's gains. That would represent another 15%-18% decline from current levels around $4,900. Probability: I'd put this at 20 to 25%. Why so low? Because it requires almost everything to go right simultaneously. Fed independence, geopolitical de-escalation, sustained dollar strength, and equity markets avoiding correction. That's a lot of things that need to happen. Base case: consolidation, then higher. Gold consolidates in the $4,600-$5,200 range for the next few months. We get volatility, we get headlines, we get worried investors. But the fundamental support holds. Central banks keep buying their 190 tons per quarter. ETF inflows moderate but stay positive. Geopolitical tensions remain elevated without breaking into actual war. Fed cuts rates modestly, maybe 50-75 basis points over the year. By year-end 2026, gold pushes toward $5,500-$6,000, with Morgan Stanley's $4,800 target representing the conservative end and potential to exceed it in Q4. Probability: 50-55%. This feels like the most likely path. Volatility, yes. Scary headlines, yes. But the structural bid stays in place. Bull case: the melt-up scenario. Now here's where it gets spicy. What if Iran and the US actually exchange fire? What if oil spikes to $150-$200 per barrel because the Strait of Hormuz gets mined or blockaded? What if inflation resurges to 6-8% while the Fed is forced to cut rates anyway because of recession fears or political pressure? What if we get a sovereign debt crisis in Europe or Japan? What if China dumps another $1 trillion of US treasuries and announces they've been secretly accumulating 10,000 tons of gold? In this scenario, and I'm not saying it will happen, but it could, gold doesn't stop at $6,000. We're talking $7,000, $8,000, maybe even $10,000 per ounce as the monetary system faces a genuine crisis of confidence. Probability: 20-25%. Lower probability, but the impact would be enormous. These tail risks are exactly why central banks and smart investors hold gold in the first place. Let's look at some interesting ratios that suggest gold has room to run. Gold to S&P 500 ratio. Currently around 0.95. In 2011, it peaked above 1.5. If stocks correct 20% and gold holds steady, this ratio improves dramatically. Gold as percent of global financial assets. Still under 1%. During previous bull markets, this has exceeded 2-3%. If we just revert to historical peaks, gold could double from here. Gold versus global money supply. The world's broad money supply has exploded since 2020. Gold prices haven't kept pace with monetary expansion. Mean reversion suggests significant upside. Now, before you rush to liquidate everything and buy gold bars, let's pump the brakes and talk about risks, because they're real. Risk number one: the 8% crash we just saw could be the start, not the end. If gold breaks below $4,600, $4,700 on heavy volume, technical damage could trigger momentum selling down to $4,000 or lower. Short-term traders could get seriously hurt. Risk number two: Warsh could actually fight inflation aggressively. If real yields go significantly positive, gold loses its appeal relative to bonds. This has happened before and could happen again. Risk number three: markets can stay irrational longer than you can stay solvent. Gold could trade sideways for years, even with bullish fundamentals. The 2011-2015 period saw gold decline from $1,900 to $1,050, despite continued central bank buying. Patience is required. Risk. Mirror 4. Storage, security, and liquidity concerns. Physical gold needs to be stored securely. ETFs have counterparty risk. Futures have rollover costs. There's no perfect vehicle. Risk number 5. Opportunity cost. Every dollar in gold is a dollar not invested in stocks, real estate, or businesses. If those assets outperform, you lose relative to what you could have earned. I want to be crystal clear. I am not a financial advisor. This video is for educational and entertainment purposes only. You should never invest money you can't afford to lose. You should never put all your eggs in one basket, even if that basket is gold. Do your own research. Consult with qualified financial advisors who understand your personal situation. Consider your time horizon, risk tolerance, and overall financial goals. That said, the case for some gold exposure in a diversified portfolio is compelling. Traditional finance suggests 5 to 10% allocation for risk management. Some investors go higher, some go lower. Find what works for your situation. The worst decision is making no decision at all and then panic buying at the top or panic selling at the bottom. Look, here's the bottom line. We are living through the most extraordinary period in financial market history. Gold just hit $5,600 and over, the highest price in human history, inflation adjusted or otherwise. Central banks are buying at rates 82% above historical averages. $89 billion flooded into gold ETFs last year. We've got potential war in the Middle East threatening 20% of global oil supplies. Federal Reserve leadership is in flux at the worst possible time. Global debt to GDP ratios are at peacetime records. De-dollarization is accelerating across emerging markets. This is not normal. This is not a drill. Whether gold goes to $4,000 or $10,000 from here, ignoring these developments is not an option for serious investors. So here's what I need you to do. First, smash that subscribe button and hit the notification bell. I'm tracking these developments daily, and you need to stay informed as this situation evolves. We're going to cover every twist and turn. Second, drop a comment below. Tell me, are you buying this dip, selling into strength, or sitting on the sidelines? What's your gold allocation? What scenario do you think is most likely? I read every comment, and your insights help everyone learn. Third, share this video. I guarantee 95% of your friends and family have no idea what's happening in gold markets right now. They don't know about the central bank buying spree. They don't know about the supply-demand deficit. They don't know about the geopolitical risks. Send them this video. It could change their financial future. Fourth, check out my other videos where I break down silver, platinum, mining stocks, and broader economic trends. Everything is connected, and understanding the full picture is critical. I've got videos covering why silver could outperform gold in 2026, the top 5 gold mining stocks insiders are buying, how to store physical gold safely without getting robbed, central bank gold buying, the untold story. These are all linked in the description below. Let me leave you with this thought. For over 5,000 years across every civilization, every empire, every monetary system, gold has survived. Kingdoms have risen and fallen. Currencies have been born and died. Empires have crumbled to dust. Gold remains. The Egyptians hoarded it. The Romans paid their armies with it. The Spanish conquered continents for it. Your grandparents hid it during wars. Central banks stockpile it today. Why? Because gold is the ultimate form of money that exists outside any government's control. It can't be printed. It can't be inflated away. It can't be hacked or deleted. It simply is. The question isn't whether gold will survive the current crisis. Gold always survives. The question is, will you be positioned to benefit when the system realizes what central banks already know? The gold rush of 2026 is here. Don't get left behind. I'm Ali, and I'll see you in the next one.